So I'm Weerts from Monocle Solutions. We're a specialist management consulting firm. We specialize in risk, finance, treasury, and compliance. I've recently moved to Amsterdam to head up our European business. And I'll be talking to you today about basics and fundamentals, which we will get into. Thank you for the opportunity to speak to you today. 2023 has been quite the year in banking, and I think if we look over the last 6 months and reflect, it's been a bit of a wake-up call. So today I'm going to talk to you about the overlooked pillar of trust. I'm going to talk to you about the things that excite you, but I might bore you slightly, and I think there's a very good reason for that. This picture represents banking in 2023. These are the topics that everyone is talking about. This is what everyone wants to talk about. This is bringing you closer to your customer. This is enabling you to do business faster and smarter. AI, machine learning, software as a service, banking as a service. This represents sexy banking. This is what we all want to do, right? This is where everyone is working towards, and these are the topics that's very, very, very much in the forefront of everyone's minds. But I want to contrast this with this, 363. What does 363 represent? This represents banking in the 50s, 60s, and 70s. Bankers borrowed at 3, they lent at 6, and they played golf at 3. I'm pretty sure that none of us in this room would have been bankers if this was still the case. Banking has very much moved on and changed. The 80s came, Gordon Gekko told us that greed is indeed good. Everyone wanted to be an investment banker. Everyone wanted to be a trader. Everyone wanted to suddenly be a banker. Now, this does not represent banking in 2023. However, is there still an inkling of truth in this? I believe there is. I had the opportunity to attend a banking conference in Brussels a few weeks ago. My colleague and I walked into the forum, and the host greeted us. He had one look at us and said to us, "What do you do for a living? Why are you here?" And we explained that we're consultants working in finance, risk, treasury, and compliance. His words to us were, "That's really serious and very boring. Secondly, you don't look like you belong here. We were dressed like this. It was a serious banking conference." And he said to us, banking has moved on. This is not what banking is anymore. There was a moment, though, where I felt quite proud to be boring in that moment. And I thought to myself, yes, banking is a serious business, and we need to take it seriously. Has the core changed? We believe not. The core of banking is still trust. Trust is the essence of banking. Savers. Savers trust banks to keep their deposits and savings safe. Borrowers trust banks to extend them with credit and manage their financial risk. Shareholders. Well, shareholders expect a return. Shareholders also expect radical transparency in the numbers that get reported to them. Internal stakeholders, the audience in front of me, you need that radical transparency to make strategic decisions on where your business is going. Lastly, regulators. Regulators require you to implement regulation, to put the guardrails in place, to keep the banking system safe. Critically important, all of this still revolves around trust. Banking hasn't changed. I contrast this to the first picture I showed you. Yes, suddenly no one looks excited anymore. This is not exciting. Regulation, compliance. However, this is your ticket to the game. This is what you have to do. These are the minimum requirements. BCBS 239, radar. If you report a capital number to your shareholders and your regulators, do you understand where that number is coming from? Do you know how it's calculated? Do you understand the integrity behind that number? LCR, NSFR. Probably the most two topical items in 2023. We've seen the impact of not doing this properly. A myriad of regulation that needs to be implemented and needs to be done well to maintain, to be a bank, to stay alive. This is important, and this should not be overlooked. I'm going to take you through a bit of a regulatory evolution timeline and overlay this with a personal story where I started my career. I started my career in 2007. This was the heyday of the Basel II implementation, and I started my career as a quant. I was employed to build predictive models to support risk management. Two things came up during this period. Number one, we were at the coalface of the global financial crisis. We were there when banks ceased to exist. Some of our clients were impacted by the financial crisis and actually went under. Two things stood out for me during this time period, and I think valuable lessons early on in a career in banking. Number one, the importance of regulation and compliance and calculating the metrics in these regulations correctly, using that in a sufficient risk management methodology. This is critical. Secondly, implementing regulation is hard. Regulations are complex and ever-changing. What makes this harder is disparate systems, processes, and a data swamp that makes this even harder. I was a quant. I was employed as a quant to build models, right? To do the predictive pieces of work, to understand risk and predict risk. I spent 90% of my time trying to source data from the correct places, trying to reconcile data, trying to understand what that data actually meant. Only 10% of my time was spent doing what I should have been doing. 2022 plus, we've been hit by a tsunami of regulatory change. More is coming. We best have our fundamentals in place to keep building on this. Andrea Enria says the following on the 28th of March, 2023. Despite the intensity of supervisory pressure in the recent years, banks with adequate risk aggregation and reporting capabilities are still the exception. Does this ring true with you? How does this sit with you? Does this keep you awake at night? If not, I think it should. This is important. 2023. What happened to the fundamentals? 15 years on from the global financial crisis. SVB Bank. A textbook case of mismanagement. Basic asset liability management gone wrong. Interestingly, SVB was one of the banks that lobbied to be exempted from the LCR calculation for a bank with assets below $250 billion. Credit Suisse, a 167-year-old financial organization. On the 14th of March 2023, it reports material weakness in its internal controls over financial reporting. 5 days later, Credit Suisse, the way we know it, is no more. First Republic Bank. A risky business model, concentrated, highly correlated depositors, a run on the bank. First Republic Bank is no more. This is 2023. These are fundamentals not being done correctly. Now, I want to take you back to the first slide. We all want to innovate. We need to innovate. We need to innovate to stay ahead of the pack, to get closer to our customers, to predict what our customers want, even before they know that they need it. That's where we want to be as bankers. However, would you build it on a foundation that looks like this? Would you add another story if the foundation of your bank looked like this? A Big Four survey recently. 83% of leading financial institutions regard data as their most valuable asset. 16% consider themselves excellent in extracting value from that data. Why is this? All of the technology, all of the platforms, why only 16%? It comes back to trust. Organizations still don't trust their data fully to extract as much value as they can out of it. So how do we go about fixing this? I've scared you. I've told you all the bad stuff. How do we turn this around? Prioritize your defensive strategies. What are your defensive strategies? These are the strategies that minimize downside risk. These are the things that you need to do as banks to be banks. These are the minimum requirements. This is regulation. This is compliance. These are the things that could be treated as tick box exercises, but really shouldn't. This should be used as a springboard to pivot to your offensive strategies. Banks are in a very unique situation where this is required. They need to spend the energy the focus to build their defensive platforms. This allows them to be banks. Use this to pivot to your offensive strategies. You have to stay in the market to actually lead the market. Now, always decisions to be made. The must-dos and the prefers to do. We all want to do that. Crossroads, decisions to be made. You have finite resources. Where do you apply those finite resources? Does it need to be either or? We believe not. These aren't mutually exclusive. This is where banks are in a unique position to be able to leverage their defensive strategies to pivot to the offense. Data products. Scalable, well-designed data products. Single sources of the truth and multiple versions of that truth. Nothing has changed. Your strategies should support this. This forms the bedrock for you to move to your offense. A single view of client, a 360 view of your client. Do you fully understand your client? Product-wise, relationship-wise. This is going to allow you to get closer to your client. Data quality. These are the bedrocks. Do you measure your data quality? Do you have those KPIs in place? If you do have those KPIs in place, do you correct the processes that cause the bad data quality? Data taxonomies. These are boring things. This is things that we don't want to talk about. This is critical. Is everyone singing from the same hymn book? Does everyone understand what is meant by certain products, attributes, that it can be used through multiple use cases? Control frameworks. Do you have those control frameworks in place during every process of data transform, extract, and loading? Your finance processes. How robust are those? Defensive strategies. Something like data lineage and integrity. This used to be a nice to have. Now it's regulation. Radar requires you to actually do this. Use this, understand your data, build the basics, pivot to your offense. Do it from a place of trust. Very, very important. I'm going to use an analogy because I'm South African. We're sports mad. We love sport. We love rugby. My South African colleagues are probably going to scold me for this, but I actually prefer to watch the French team play rugby. They play a beautiful version of rugby. It's flair, it's attacking, it's entertaining. The Springboks, my home team, South African team, often criticized for being boring, defensive, and generally not nice to watch. The Springboks have won 3 Rugby World Cups. The French have been in the final 3 times, yet to win. Offenses sell tickets. Defenses win championships. So, that is the theory. I'm going to take you through a success story where a large banking group actually used their minimum requirement defensive strategies and turned it into an offensive strategy that unleashed the potential for a data platform to be leveraged for a totally different use case. In June 2018, a large banking group had material regulatory as well as internal and external audit findings around the accuracy and timeliness of their LCR, the liquidity coverage ratio, and NSFR metrics. LCR on a daily basis, NSFR on a monthly basis. Critical metrics for calculation under Basel III. This is asset liability management. These are the basics. As part of the findings, the bank was given 18 months by its board to overhaul their platform, to fix everything that was wrong, and 24 months by the regulator. The bank embarked on a large-scale program to overhaul their analytics platform. As part of the first phase of the project, we did a deep dive as-is analysis to understand what the current landscape looked like. A couple of things sprang out to us in the first few weeks. Number one, data sourcing. The age-old problem. Data was being sourced from source systems, sometimes without source system owners even knowing that data was being accessed and pulled from their databases. To do LCR NSFR reporting. Data not intended for the asset and liability management analytics world was being used and leveraged to actually try and do this reporting. Mistrust in the numbers. Because of bad data quality, business owners couldn't attest to the data that they were providing to a central treasury and risk management function. This obviously caused a lot of tension between business units and the central risk functions as well. The bank had major gaps in its BCBS 239 compliancy, did not understand where the data was coming from, did not understand the transformations that happened to the data. Reconciliations was an absolute nightmare. Very much a top-down approach to reconciliations, not reconciling throughout the process. These are just a couple of things that sprang to mind and what we saw in the first few weeks of doing this project. We realized that this required a complete re-engineering. The success story: 18 months later, the bank was compliant from an internal perspective, and 23 months later, it was deemed compliant by the regulator from a BCBS 239 perspective. How was this done? We went back to the basics. We grounded data provisioning in defensive data platforms. Data contracts were signed with the various franchises and legal entities within the banking group. These defensive data platforms, we took a top-down and a bottom-up approach. We anchored our solution in the finance world. We leveraged control frameworks in the finance world on a daily and monthly basis. Where these controls weren't in place, those were put in place. Where operating models had to change, those operating models were changed. Finance understood what the data was being used for. We expanded on this data set by adding low-level trade transactional position data. A very rich data set was created, anchored in our defensive data platform, self-reconciling. Add to this our customer dimension, our client dimensions, instrument dimensions of data, where instruments could be revalued, repriced from first principles, compared to the output from risk engines, understanding what the differences were in the results, being able to explain that on a daily and a monthly basis. Reconciliation. We didn't reconcile at the end of the process. Because we built it on our defensive data platforms, we understood what those deficiencies could have been on the specific day. Control frameworks were put in place to provide the data. A scalable data product. We built a data product that was flexible, that could be built and could be used for more than just the defensive data strategies. Data taxonomies. Business understood how the data model actually worked. Business also understood the concepts that we spoke about. Commonality was found. Business added to the data model and to the taxonomies, a common understanding. Everyone started to understand what this platform could be used for. Multidisciplinary execution teams. Data engineers understood what financial engineers had to do, understood what accountants had to do, all the way through the process. Why? We grounded the data in a defensive strategy. We built the taxonomies and the data models that was easily understood and scalable. Importantly, business strategic buy-in. This could have been another grudge purchase. Day one, another regulatory requirement that was going to take resources away from the things that we prefer to do. This is not the case. We took the business on the journey. The business understood that this platform could be leveraged for way more than what they intended or what was intended just from a regulatory perspective. The building blocks were put in place for them to use the platform to do their own scenario analysis, to do their own stress testing, to do their own balance sheet optimization. A risk platform were put in businesses' hands to stress their books. They were given freedom to do what they needed to do as a business, do the analytics, but build it from a place that was trusted. Build it from a place that they knew the control frameworks were in place, and whatever was predicted from this data was accurate. The impact of the solution. I come back to the beginning. Trust internally and externally. Externally, recently the South African Reserve Bank had a series of fire drills over a week period where banks had to produce specific metrics under stress scenarios and report on that by end of day. This specific South African banking group did the best in the market. They were praised by the regulator for being so efficient in doing their reporting. Trust was regained. Internally, business understood their data. Business trusted their data. Their data was being used for the business and use cases that they wanted to do. They did their analytics. Future-proofing for regulatory change. The tsunami of change that's coming from a regulatory perspective. We built a foundation. A solid foundation where the addition of data attributes with a different lens on the same data made the implementation time for new regulation much shorter. An example, deposit insurance was a relatively new concept in the South African market at this stage. All we had to do was add a couple of customer information pieces to the already existing data model. We put a different lens on the same version of the truth, and we were compliant. If we did this from scratch, this would have been another massive program. We reduced costs. We did not have to start from scratch. More importantly, bankers did what they were supposed to do. Data scientists and quants did modeling. They didn't do the data sourcing and the reconciliation that I had to do. Lastly, adoption. Business adopted a platform, understood its value, understood that minimum requirements were met, the regulator was happy with what they were seeing, and they could leverage this data source for analytical purposes to do what they needed to do. This is not exciting. This is not the first slide. Be bold to be boring. Get the basics right. Build the foundations. Leverage it. Use the technologies to get closer to your customers and deliver more value. Thank you.